Welcome back, welcome back, welcome back. This video is brought to you by Good For You Vending, and Good For You Vending will be sharing with us Meta's first quarter's earnings call Q&A. And with that, we'd like to get it started.
Joining me today to discuss our results are Mark Zuckerberg, CEO, and Susan Li, CFO. Before we get started, I would like to take this opportunity to remind you that our remarks today will include forward-looking statements. Actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are set forth in today's press release and in our annual report on Form 10-K filed with the SEC. Any forward-looking statements that we make on this call are based on assumptions as of today, and we undertake no obligation to update these statements as a result of new information or future events. During this call, we may present both GAAP and non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The press release and an accompanying investor presentation are available on our website at investor.fb.com. Now I'd like to turn the call over to Mark.
All right. Your first question comes from the line of Brian Novak with Morgan Stanley. Your line is open.
Thanks for taking my questions. I have two, one for Mark, one for Susan. Mark, first one for you is on generative AI and how you think about generative AI and some of the vision models and your large language models potentially impacting your long-term advertising business and finding ways to deliver more value for advertisers over the next 2, 3, 5 years. How do you see Gen AI impacting advertising? Then the second one for Susan, just as we're thinking about hiring expectations for 24 and beyond, I think there's been some ink in the press about potential 1 to 2% hiring going forward. Can you just talk to us about that a little bit, and how does using AI internally factor in your thoughts about long-term hiring? Thanks.
Yeah, I can start off by taking the generative AI question, although there aren't that many details that I'm going to share at this point. More of this will come in focus as we start shipping more of these things over the coming months. But I do think that there's a big opportunity here. You asked specifically about advertisers, but I think it's going to also help create more engaging experiences, which should create more engagement, and that by itself creates more opportunities for advertisers. But then I think that there's a bunch of opportunities on the visual side to help advertisers create different creative. We don't have the tools to do that, over time, eventually making it so we've always strived to just have an advertiser just be able to tell us what their objective is and then have us be able to do as much of the work as possible for them. And now being able to do more of the creative work there and ourselves for those who want that, I think could be a very exciting opportunity. I also think that there's going to be a very interesting convergence between some of the AI agents and messaging and business messaging, where right now we see a lot of the places where business messaging is most successful are places where a lot of businesses can afford to basically have people answering a lot of questions for people and engaging with them in chat. And obviously once you light up the ability for tens of millions of small businesses to have AI agents acting on their behalf, you'll have way more businesses that can afford to have someone engaging in chat with customers. So I think that could be a pretty big opportunity too. So those are just a few of the things that we're looking at. I think this is very broad. Like I said, I think this is literally going to touch every single one of our products and services in multiple ways. And this is just a very big wave and new set of technologies that's available, and we're working on it across the whole company.
Hi, Brian. It's Susan. Thanks for the question. You were asking about the 1 to 2% headcount growth stat that's been out there, and I thought it was worth clarifying. So that comes from something Mark mentioned in a recent internal employee Q&A that he had expected company headcount to increase only 1 to 2% year over year. And I want to clarify that Mark was actually speaking to employees about headcount budgets that have already been allocated. What we've also said previously is we have been in a broad-based hiring freeze for the last half year. And as we complete our layoffs in April and May, we will resume hiring, and we would expect headcount growth in excess of 1 to 2% in 2024 as a result, as we ramp up those recruiting pipelines. But our long-term focus is very much on efficiency, and as hiring resumes, you'll find the biggest areas that we are hiring in will be to support priority areas like generative AI, ads, infrastructure, Reality Labs, some of the areas that we've been talking about. And you also asked about using AI internally and how that factors into our thoughts on long-term hiring. You know, we certainly don't have enough visibility yet into how AI will make our workforce more productive, but it's something we're excited about. And I think we will have more clarity on that as more tools begin getting developed to enhance employee productivity across the industry.
Your next question comes from line of Eric Sheridan with Goldman Sachs. Your line is open.
Thanks so much for taking the questions. Maybe two, if I can. Mark, I was intrigued by your comment about open source and open systems with respect to AI. You know, obviously we're coming off of Web 2 and mobile, where there were a lot more walled gardens and ecosystems. Can you talk a little bit about what you might want to try to do, either from a priority or an investment standpoint, to be a driver of more open-ended systems in AI compared to what we saw with Web 2? And then maybe for Susan, you introduced the concept last quarter about revisiting your data center architecture over the medium to long term. Is there any update there for us in terms of how to think about AI as a driver of data center architecture medium to long term, or what that might mean for capital intensity? Thanks so much.
Yeah, I can take the first one. I think that there's an important distinction between the products we offer and a lot of the technical infrastructure, especially the software that we write to support that. And historically, you know, whether it's the Open Compute project that we've done or just open sourcing a lot of the infrastructure that we've built, we've historically open sourced a lot of that infrastructure, even though the products themselves are obviously, you know, we haven't open sourced the code for, you know, our core products or anything like that. And the reason why I think why we do this is that, you know, unlike some of the other companies in the space, you know, we're not selling a cloud computing service where we try to keep the different software infrastructure that we're building proprietary. For us, it's way better if the industry standardizes on the basic tools that we're using, and therefore we can benefit from the improvements that others make, and others' use of those tools can, in some cases like Open Compute, drive down the costs of those things, which make our business more efficient too. So I think to some degree we're just playing a different game on the infrastructure than companies like Google or Microsoft or Amazon, and that creates different incentives for us. So overall, you know, I think that's going to lead us to do more work in terms of open sourcing some of the lower level models and tools. But of course, a lot of the product work itself is going to be specific and integrated with the things that we do. So it's not that everything we do is going to be open. Obviously, a bunch of this needs to be developed in a way that creates unique value for our products. But I think in terms of the basic models, I would expect us to be pushing and helping to build out an open ecosystem here, which I think is something that's going to be important.
Hi, Eric. So I think your question had two parts. The first was an update on the data center architecture that we announced last quarter. And, you know, we're progressing with construction there, but the new data centers that we're building are intended really for future year capacity, so they won't come online for a few years. So we don't have too much more to share there, except that work is ongoing. And the second part of your question was really, I think, about how AI might drive capital intensity over the next few years. So, you know, you can really think about our CapEx investment as having three broad buckets. The first we've talked about before, non-AI compute needs. You know, we do have ongoing general compute and storage needs to support the existing business, but this is an area where we've become much more efficient in terms of capital intensity and are very much focused on continuing to do so over time. The second area is in our core AI investments, which is really most of our AI investment today, and that's supporting the, you know, building of the discovery engine, ranking unconnected organic content, ranking ads. And we're focused on measuring the return of those investments and making sure that we feel good about the ROI of our spend there, and that really will drive our future plans in terms of that core AI spend. And then the third bucket is really around CapEx investments now to support Gen AI. And this is an emerging opportunity for us. We're still in the beginning of stages of understanding the various applications and possible use cases. And I do think this may represent a significant investment opportunity for us that is earlier on the return curve relative to some of the other AI work that we've done. And it's a little too early to say how this is going to impact our overall capital intensity in the near term. So to the extent that we spend more on CapEx in the near future, I expect it mostly to be to power this work. But I want to emphasize that we remain focused overall on striking the right balance between building out the AI capacity we need and being efficient with our CapEx spend.
Your next question comes from the line of Mark Shmulik with Bernstein. Your line is open.
Yes, hi, a couple questions. Mark, this one's a bit more philosophical, but if we compare where Meta is today, kind of pre-IDFA cookie deprecation type of world, how do you see the relative competitive position in digital advertising in light of all of these technical integrations and AI tools? Because I think the prevailing view was that privacy would level the playing field, but it certainly doesn't seem that way. And then second for Susan, I certainly appreciate the outlook on the revenue guidance. But in light of some of the commentary we've been hearing about U.S. consumers trading down, is there any additional color you can share about kind of where you're seeing strengths and weaknesses effectively quarter to date and beyond? Thank you.
Thanks, Mark. I can go ahead and take both of those. So your first question was about the post-ATT landscape and how we're positioned in terms of our ads business. We've talked really a great deal, of course, about this over the last few years. We're making progress, certainly, in mitigating the direct impact from ATT's platform changes. But this is really, I think, just the reality of the online advertising environment that we're in now. And we've invested across not only sort of the direct mitigations that we've talked about in the past, including things like Conversions API, but really, I think now we're focused on improving ad performance in the current signals landscape with our investments, both in increasing the volume of ads with on-site objectives, and then second of all, with our AI investments that have really, I think, enhanced the performance of our ads, as well as enabled us to introduce new tools and features for advertisers. So I think we're quite well positioned here in terms of on-site conversions. We have a lot of offerings that have been growing very well for us. I think we've talked a lot about click-to-messaging ads and what that has meant in terms of driving growth for our business and new business opportunities. Other formats that have been, I think, performing well in terms of on-site conversions are lead ads, shops ads. So there are different ad formats that we're working on there. And then we've just really been investing in using AI for a long time to improve our ad systems, including ranking, to improve our modeling and measurement, and to, again, support the introduction of new AI-powered tools and products. So, I think we feel quite good about our relative position. Again, this is just work that we've been doing for a long time that I think in conjunction with seeing some stabilization in the macro environment has enabled us to see that work pay off. And then your second question was about strengths and weaknesses in sort of the Q1 revenue performance as well as in our outlook. In terms of, the Q1 revenue performance and the acceleration relative to Q4, we certainly saw stronger demand, including the impact of lapping the Ukraine war, which began in Q1 of 2022. And in particular, we saw acceleration among advertisers in China targeting users in other markets, which we believe was due in part to dropping shipping costs and easing COVID lockdowns for those advertisers. And then you've seen FX play a part there as well. Looking forward to Q2 and the back half of the year, it's certainly an easier compare there, as there are tailwinds to year-over-year growth coming from lapping a weaker demand period, and then moving into the first full quarter in Q2 without Russia revenue in terms of the comparison relative to Q2 2022. And we certainly expect that currency is also going to be less of a headwind than it was in the first quarter. With that said, there's a broad range of expectations captured in our Q2 outlook, and it reflects that we feel it remains a volatile macro environment. The market has absorbed a lot of new developments over the last year with inflation, higher interest rates, banking instability, et cetera. And it's hard to have perfect visibility on how those dynamics will impact the broader economy and specifically the advertising markets, for Q2 and for the rest of the year. It also continues to be a challenging regulatory environment, so that's something that we're continuing to monitor closely. But on the other hand, we've been pleased with the performance we're delivering for advertisers and how those investments have paid off. Core engagement trends remain strong, and Reels is a revenue headwind today that we expect will become revenue neutral by the end of the year or early next year. Again, we expect FX will be a tailwind, and again, we're lapping relatively softer comps. So lots of puts and takes as we look beyond, as we look into Q2 and beyond.
Your next question comes from the line of Doug Anmuth with JP Morgan. Your line is open.
Thanks for taking the question. Susan, you've talked about the goal of building the muscle for long-term financial discipline. Just given the restructuring that we've seen across the business so far, how far along are you in building this muscle, and what gives you the confidence that it's durable and sustainable long-term, even in a better macro environment, especially given all the work ahead on AI and the metaverse?
Thanks, Doug. I think there are a couple components to this. A lot of this efficiency work that we've been undertaking, and especially this year, is driven not sort of by solely financial imperative, but really with the focus of increasing operational efficiency. So that's been, I think, one of the foremost goals, and a lot of the work has been architected around that. And that really includes more carefully scrutinizing roadmaps, winding down projects that are no longer, at the top of our priority list, reprioritizing investments. That's really a muscle that I think we have spent a lot of time building over the last, half year, and I expect that we will be carrying that discipline into the way that we assess our product roadmaps going forward. Similarly, I think a lot of the work that we've done around increasing operational efficiency, around making sure that we feel good about management spans and layers and all, that work, I think, is also in service of making us a company that can build more and ship faster. And we would expect to sort of continue to make sure that we think our organizational posture is really, in service, again, of building and shipping product. And, as we move forward, including out of the sort of the layoffs that we've been implementing and the direct restructuring work, we're going to continue focusing on efficiency work, including in other areas like helping developers build and ship quality products faster. We're going to be investing in tooling where we can to increase the velocity of product development. And we'll continue streamlining, cross-functional or processes that, might tax the development process or slow us down, and make sure that we're really focused on also increasing the quality and frequency of collaborative and in-person time to build, relationships across the organization and get things done faster. So, this is all, I expect this to all be very much ongoing for us in the years to come.
Your next question comes from the line of Justin Post with Bank of America Merrill Lynch. Your line is up.
Hi, thank you. This could be for Susan or Mark. I think really interesting stat on Instagram time you gave, but just wondering how you characterize the health of the Facebook user base and usage on the site. Obviously, DAUs went up to 68% this quarter. I think Asia was really strong. But what are you seeing there? And is there kind of a catch-up here where the Reels content could start really helping Facebook time spent as well, as you saw with Instagram? But just stepping out, I think there's a narrative that that usage could be flat or down. Just wondering what your thoughts are and what you're seeing on the core Facebook. Thank you.
Thanks, Justin. In terms of core Facebook, user growth, we've been pleased with the growth of the community and the engagement trends that we've been seeing. In particular, I think in Q1, DAU growth benefited from strong product execution. But I should also note that Q1 is a seasonally strong engagement quarter for us, so that, has some benefit in terms of quarter-over-quarter growth. You mentioned sort of whether the work in Reels is driving incremental or is driving engagement in Facebook. And what I would say there is that more broadly, sort of the discovery engine work for us and the investments we've made ranking unconnected content, is expansive beyond Instagram, and I think is certainly a part of what is also driving growth on Facebook as well.
Your next question comes from the line of Youssef Squali with Truist Security. Your line is open.
Great, thank you. I have two questions. I guess relative to OPEX guide from Q3 of last year, the new guide at the midpoint implies something like $10 to $15 billion lower adjusted for the restructuring costs. How does this impact your expectations for growth well beyond 2022? I'm not talking about this year. I'm just talking about the next, say, 2 to 3 years. Is it trying to get a sense of, is it all about efficiency, or are we potentially cutting into the bone? And then on the regulatory front, can you just help explain how changes to the transatlantic data transfer rules may impact your European business as it goes into effect? Just trying to get a sense if we have a potentially an IDFA situation with a signal loss here again. Thank you.
Yeah, Youssef, thank you. For your first question, how much sort of has the OPEX, the total expense guidance coming down, especially since we sort of issued our first pass of guidance in Q3 last year, how has that downward sort of trend impacted our expectations beyond 2022 in the next 2 or 3 years? We certainly haven't shared expense guidance for the out years, and frankly, that's something that we are ourselves working on internally as we lay our long-term, as we undergo our long-term planning exercise. But I do think that a lot of the muscle that we're building with regard to efficiency is going to translate into the longer run roadmap. And so I expect that, we have really improved our cost structure over the last 6 months, and that's going to form the basis, along with an increased focus on operating efficiency going forward. I think that's going to form the basis for sort of our future outlook. And making sure that we are kind of constantly evaluating our investment roadmap to make sure that we are investing against the highest priority work and deprioritizing and winding down investments again where we don't see the ROI or we don't see a compelling opportunity. So again, we don't have guidance to share yet on the out years, but I do expect the overall efficiency ethos very much to be a part of the coming years. On your second question, on what the potential impact to our European business is of the transatlantic data transfer rules. So first, I want to emphasize we continue to be hopeful that the new EU-US privacy framework will be implemented before a deadline for suspension. But if it comes to that, there's a lot that we don't know in terms of the specifics of a final order and how long a suspension order would last, which would be important variables in determining the overall impact. What we do know is that roughly 10% of worldwide ad revenue comes from ads delivered to Facebook users in EU countries. But there are more details that we would need to understand, including the impact on advertisers in EU countries, before we'd be able to really provide a more accurate or fulsome estimate of that impact.
Your next question comes from the line of Mark Mahaney with Evercore ISI. Your line is open.
Okay, thanks. 2 questions. Are there any restructuring charges still to be had, Susan, in Q2 or, beyond that $3 to $5 billion that you talked about? We pretty much see all of that in Q1. And then secondly, I wonder if I could just go back to the broader opportunity around click to message. Facebook has had these 2 wonderful assets, or just 3 now, messaging assets, but really leading off with WhatsApp for quite some time. It's always sort of under monetized versus some of the other leading assets, but that seems to have really started to change. The numbers are becoming material. You mentioned that there's a real power alley in terms of marketers in Latin America and Southeast Asia. How can you take what is really a differentiated product and really kind of blow it out more? Is there anything, other steps you can take to really get more advertisers to realize the opportunity, just given the kind of cultural shifts, if you will, towards embracing messaging? Thank you very much.
Thanks, Mark. So on your first question about restructuring charges, Q1 restructuring charges are in the range of $1.1 billion, and then we gave a range of $3 to $5 billion for the full year. So we do expect that we will be recognizing further restructuring charges throughout the year. And then the second question about the sort of opportunity in click-to-messaging ads, and particularly in WhatsApp, what does the opportunity look like there? This is an area that we're very excited about. We've invested a lot. We see continued opportunity to scale click-to-message, particularly in WhatsApp, and the click-to-Instagram direct area. Both of those are earlier on the growth curve. And we're investing in, a few areas to continue making it easier for people and businesses to connect. First, we're really investing in trying to make it easier to create ads. So in the last year, we've invested in a revamped experience in Ads Manager, native ad creation experiences directly in WhatsApp. We're also scaling partners. So with the cloud-hosted API, we now have hosted API solutions across WhatsApp, Messenger, and Instagram, so that our ecosystem of developers can help build good, best-in-class experiences for businesses. And then we're also working on making these ads more performant by driving more action further down funnel. So we're working on ranking and optimization to yield better conversion from these ads and introduce new ways to drive outcomes. We've introduced new features like in-thread payments and other commerce tools. So we think that there's a big opportunity here. We're trying to make every part of the experience for advertisers easier, better, and more performant. And we're excited to also see growth beyond, the core markets here in Southeast Asia and Latin America, where messaging is already common as a way for businesses to engage with customers, and their customer prospects. But, we're hopeful that we'll see this also take off in other markets. We're seeing strong growth in the U.S. and Canada, but it's just earlier there today.
Your next question comes from the line of Ross Sandler with Barclays. Your line is open.
Hey, one more for Mark on the open sourcing of the models and infrastructure for generative AI. So do you view that as kind of an opportunity for developers to plug in to help ultimately improve engagement and revenue on your family of apps, or do you think there could be other kind of business models that come out of that, like APIs and other types of partnerships? Just any thoughts on that? And then second question is back to the 24% increase in time spent on Instagram from Reels and content ranking. Pretty incredible. So how much of that was like lost engagement from folks like TikTok that you're now recouping? And how do you think about how much more runway you have to increase that, or when you layer in the discovery engine across Blue and other apps as you're doing right now, is there some kind of benchmark you look at for increasing time spent? Is it 20%, 30%? Any thoughts on that? Thank you.
Sure, I'll take the first one, and then Susan can take the second one. On the AI tools, and we have a bunch of history here, right? So if you look at what we've done with PyTorch, for example, which has generally become the standard in the industry as a tool that a lot of folks who are building AI models and different things in that space use. It's generally been very valuable for us to provide that, because now all of the best developers across the industry are using tools that we're also using internally, so the tool chain is the same. So when they create some innovation, we can easily integrate it into the things that we're doing. When we improve something, it improves other products too. Because it's integrated with our technology stack, when there are opportunities to make integrations with products, it's much easier to make sure that developers and other folks are compatible with the things that we need and the way that our systems work. So there are a lot of advantages, but I see this more as a kind of back-end infrastructure advantage with potential integrations on the product side, but one that should hopefully enable us to stay at the leading edge and integrate more broadly with the community, and also make the way we run all this infrastructure more efficient over time. There are a number of models. I just gave PyTorch as an example. OpenCompute is another model that has worked really well for us in this way, both to incorporate both innovation and scale efficiency into our own infrastructure. So I think that there's our incentives, I think, are basically aligned towards moving in this direction. Now, that said, there's a lot to figure out, right? So when you asked if there are going to be other opportunities, I hope so. I can't speak to what all those things might be now. This is all quite early and getting developed. The better we do with the foundational work, the more opportunities I think that will come and present themselves. So I think that's all stuff that we need to figure out. But at least at the base level, I think we're generally incentivized to move in this direction, and we also need to figure out how to go in that direction over time. I mean, I mentioned Llama before, and I also want to be clear that while I'm talking about helping contribute to an open ecosystem, Llama is a model that we only really made available to researchers, and there's a lot of really good stuff that's happening there. But a lot of the work that we're doing, I think we would aspire to and hope to make even more open than that. So we'll need to figure out a way to do that.
And Ross, on your second question. Oh, sorry. I think there was a second part to the question, which is really about Reels driving an increase in time spent on Instagram and how much runway we see. So, we certainly aren't quantifying, the kind of the expected engagement growth, but we're very pleased with what we've seen Reels drive in terms of incremental engagement to the platform so far. And we've talked about how the incrementality has grown over time, and that's important, as we've continued to improve ranking, because we're very focused not only on the absolute growth of Reels, but on increasing the incremental engagement, and that's something where we're very pleased with the trends that we've been seeing. As it comes to plays, watch time, reshares, reactions, all of the metrics that, we keep an eye on, we're seeing meaningful growth in Reels. It's clear that people value short form video and recommendations. It's also unlocking an entirely new content pool, which we think creates an engagement opportunity as we help people discover more interesting posts. And then that's really valuable on top of the social graph. And we're seeing the sharing flywheel take off with the growth of Reels reshares, which has doubled over the last 6 months. And then more broadly, in terms of how the discovery engine is driving incremental engagement across the platform, our in-feed recommendations certainly go well beyond Reels. They cover all types of content, including text, images, links, group content, etc. And, on Facebook, we see that AI-driven recommendations are continuing to grow and contribute to increasing engagement, on the app. So, again, we're not quantifying this, but it's a place where I think we are both pleased with our progress and see significant opportunity for us to do better. Operator, we have time for one last question.
Certainly, thank you. That will come from the line of Michael Nathanson with MoffettNathanson. Your line is open.
Thank you so much. I have two, if you can hear me. The first is, Susan, I appreciate the confidence about Reels monetization going forward. But can you share a bit, what's giving you that confidence that it goes from a headwind to neutral to a tailwind down the line? So anything you share on data points about ROAS or adoption? And then just quickly, all the updates on Messenger are really, were great to hear. Do you think the adoption is also being driven by maybe loss of signal? And how does messaging improve marketers' ability to basically retarget on post-IDFA? So anything on signal loss, how messaging helps you marketers regain that? Thanks.
Thanks, Michael. So on Reels, we have shared for, I think, a while now that we're working down the headwind to revenue from the growth of Reels cannibalizing some time that is spent on our more mature ad services, Feed and Stories. And basically, we have been balancing the two factors here, which is the degree to which Reels is driving incremental engagement on the platform, versus the lower monetization efficiency of Reels relative to the Feed and Stories engagement that it cannibalizes. And ultimately, the overall economics of Reels is really going to be determined by the combination of those two things. The thing that I would, so while we're on track to Reels becoming neutral to revenue by end of year, early next year. But I do think it's important to call out that Reels is structurally different from Feed and Stories. And so, we don't have line of sight of getting Reels to monetization parity per time with Feed or Stories anytime soon because of those structural differences.
But because it drives incremental engagement, we expect that we will continue, and we expect we will continue to improve its monetization from current levels. So we expect the combination of those things, will get us to revenue neutral by end of this year, early next, and positive to revenue beyond that, despite that it doesn't monetize as efficiently. The second part of your question was updates on messaging and how does messaging improve, marketer ability to retarget in face of signal loss. So click-to-messaging ads are a really important part of our overall ad strategy in terms of on-site objectives. And so it is a big part of the sort of first-party data playbook. And so I think, from that perspective, it really has it is both sort of a first-party data ads format, which I think in a signal challenge landscape is important for us. And then, of course, it's a way for us to both monetize messaging behavior that's happening on our platform and create, robust avenues of communication for businesses directly with their consumers, which we hope to broaden, with broader business messaging offerings over time. So we're very excited. We're really excited with the progress that click-to-messaging ads have shown and, the business opportunity that we have going forward there.
Great. Thank you for joining us today. We appreciate your time, and we look forward to speaking with you again.
This concludes today's conference call. Thank you for joining us. You may now disconnect your lines.
All right, guys. So you have it, man. Good for You Vending. We actually own their stock. So, hey, like we said, we're not financial advisors, just willing to teach people things that we're learning. And Meta is actually really planning for the future and things to really come. So keep going, keep doing the good work. And we look forward to being able to bring these calls and others to you as soon as possible. Thank you and have a great evening.